As we enter the last month of 2017, we can reflect on a pretty strong year for stocks, a stable year locally for interest rates and bonds, and for property, deceleration from the strong growth earlier in the year. A quick update on this and our forecasts for 2018. A year ago, our stock market was looking shaky in the wake of global concerns, including uncertainty from the US president and his erratic tweets. But as the chart shows, it turned out to be a very constructive year, with our stock market up roughly 9% over this period, and global stocks recording healthy gains around the globe. Not only have US shares reached fresh record highs over the last few days, including the Dow, the Nasdaq, and the S&P 500 index ahead of the tax reforms, but Japan, Europe, and emerging markets have joined in the rally. So equity markets still have a spring in their step and appear to be the preferred asset class over bonds and property, which is hard to argue against going into 2018. For bond markets and interest rates, it remains a growth recovery environment where global rates are normalising from record lows. But for Australia, this path back to neutral will lag offshore markets, given we didn't cut rates quite as low as the US, Canada, Europe or the UK. There's still a wide range of forecasts for when our Reserve Bank will kick off their tightening cycle. But what we can say for sure is the RBA will be breaking their record for the longest pause in Australian interest rates. By February, this will be over 18 months. And some are suggesting another year of inaction on top of that. We're still suggesting a rate hike in the second half of 2018, although the timing there is challenging to pin down. And part of that challenge is anticipating where property markets are heading, as well as inflation, growth, and the Aussie dollar. We lean to inflation moving back to 2% by mid-next year, growth to recover back to 3% over the same timeframe, and the Aussie dollar not deviating too far from its recent 75 to 81 cent band in the short term. As for property, clearly property prices have decelerated back to close to flat or even negative in some areas, with auction clearance rates in the capital cities lower as well, with the impact of investor lending via macro-prudential policy very clear in this chart. This trend seems well entrenched, with these policy changes having taken the heat out of the housing market without needing to lift official rates, which explains why business sentiment remains so strong, partly evidenced in yesterday's pleasing capital expenditure data, especially with non-mining capex moving higher. More on our outlook for 2018 in the next market update from Bendigo Bank.